Hey everybody, Real Estate Ninja here. I hope you're doing great. We're going to talk about the banks. We're going to talk about mortgages and their lack thereof in the near future because they are going to constrict their lending and they're going to charge higher fees, higher interest rates because of what has just happened with the M2 money supply. That's right. Got a story out of the Daily Huddle. Let's dive right in. It's entitled Americans Pull $472 billion out of U.S. banks in 3 months as depositors exit in historic numbers. So let me stop right there real quick and explain the M2 money supply. That is the accounting of all savings accounts, checking accounts, cashier's checks, and a couple of other products, essentially hard cash, right? That you can go into your bank and grab onto right now, or if you can, if the bank actually has it in there. It has been actually falling for over 6 months. When you look at the M2 money supply out of the St. Louis Fed, they have a chart. You could see it has been, it crested and has been dropping for 6 months. That actually led to what happened 3 months ago with the 3 banks going down, Signature Bank and the others, right? This is Silicon Valley Bank. You guys know what I mean. Point being is that has been falling, okay? And what is going to continue to happen is banks are going to need liquidity. That's why the Fed opened up the repurchase window. They're able to put certain assets up for collateral and gain dollars that they need in their accounts to be sure that they are within that fractional reserve banking amount. Problem is the banks, as this historic, and I mean no joke, this is a historic bank run that's been going on. We haven't seen a run like this since 1929. They may run out of assets to put up for collateral. And then the Fed's got a whole new deal to deal with, a whole new issue to deal with. And the reason why is because this is sheerly so much money being pulled out, right? And every day there's 2 issues. People do not trust banks. And the other issue is people are starved for yield because we're dealing with massive inflation. And it's going to turn into some transitory hyperinflation in certain assets like energy and like food. My point being is that they're going to start to really constrict, and they're already doing it. They're already getting really tight with who they give mortgages to because they also know that the housing market is stalling and crashing. So they don't want to loan money out, just like in the auto industry. They're doing that with auto industry where you see Ally Financial and other big companies literally walking away from giving auto loans because they're like, why would we give you a 100% LTV or possibly an 80% loan to value on an object that we know is falling so drastically in price that if you forfeit the payments, you stop paying us, we're screwed. And so they're thinking the same thing with houses. When they're looking at news articles about Austin, the housing market that is just crumbling as fast as you're watching. It is just going down, down, down. And every day there's more homes going on the market. So banks don't want to give these amounts out. So in the story, think about this. New numbers from the Federal Deposit Insurance Company, or FDIC, Corporation, show Americans are pulling their money at a pace not seen in nearly 4 decades. According to the FDIC's newly released quarterly report, let me stop there too. When they talk about the 4 decades, still M2 is still at a much greater pace than what happened in the late 70s, early 80s. I want you to remember what happened though. Back in the late 70s when these were pulling up, what happened to mortgage rates? They went up to eventually, Paul Volcker had to bring them to around 18.75% from a usual average number between 9 and 10%. So we saw that go up drastically. I believe you're going to see something similar. We're going to see over 10% mortgage rates, I believe, this year. It said the quarterly decline is the largest reduction reported in the QBP since data collection began in 1984. This was the 4th consecutive quarter that the industry reported lower levels of total deposits. The primary driver of deposit flight came from unsecured deposits, says the FDIC, as people moved to protect capital that is above the $250,000 FDIC insured maximum. That's actually not true. And this is why I'm going to explain this. If people had, let's say, $500,000 in one bank, more than likely, 99% of them would pull out $250,000, so they're staying within that FDIC number, and they would put it into another bank, okay? These numbers are coming from all the banks, all right, that the FDIC insures. So that proved to you that that is a lie. It's no joke. But they put this kind of stuff in there so you glaze over it and you go, oh yeah, that's okay. It's, everybody's just trying to protect themselves. No, that money has to flow somewhere. It's called sloshing. Money sloshes around. It flows somewhere, goes from somewhere to somewhere else. So if that was true and people are just pulling out, they got $1 million in the bank, they go, I need to put into 4 accounts under that $250,000 threshold so I'm insured by FDIC, that money would still be in the system. It's actually being pulled out of the system. People are buying gold. They're putting it into money market accounts, which do not account in the M2 money supply. And they are literally exiting that type of money savings account, holding account, all right? So the mass exodus follows the failures of Signature Bank, Silicon Valley Bank, and First Republic, which were triggered in large part by the Federal Reserve's aggressive rate hikes. Yeah, see, I have so many problems with all these stories. That was not triggered, okay, it was in the fact, though, the triggering of the rate hikes triggered people to go and get yield. But it's not because of the rate hikes. The rate hikes did not create inflation. You see, the rate hikes are intended to quell inflation, to slow it down, to stop it, right? But the facts are, you can't get control of inflation, runaway inflation, which we have right now, because if it wasn't runaway, the government and the Fed would have been able to stop it in a second. They can't. They've been trying for like a year and a half now. Or no, actually just about a year. What happens is inflation is the reason why people are pulling this money out, okay? It's happening because of out of control spending and now panic over the last couple of years. As rates went up, people started to buy extra things. We started to see attacks from other countries, like what's going on with Saudi Arabia and raising the oil price through slowing down their production, things like that, okay? As depositors are leaving the banking system, money market funds have witnessed massive weekly cash inflows. As the first quarter came to a close, assets held by money market mutual funds surged to $5.6 trillion, according to Crane data, representing a record high. Look, the facts are money is moving here and there, and it's doing it fast. And what's really scary is watching, how many insiders are selling stocks right now. That tells you a lot as well. Why? Because as panic starts to really grip a nation, they start to liquidate their stocks. And it's not until the Federal Reserve moves in and the government allows the Federal Reserve to loan the money so that they can start bailing out certain sectors, that's when we start to see the real money explosion, and then people panic. I do not believe that we're going to see hyperinflation in homes and in stocks like we would when you had like the Weimar Republic or when you had Venezuela or Turkey. Those stock markets rise in value pretty substantially because of the money printing that's going on, and people are starved for yield, so they're going out and buying stocks, hoping that it keeps up with the inflation rate, which it never does. I believe because we still have the reserve currency status, I know we're clinging onto it by a thread, but countries still are using and needing dollars. So that holds back that money flow from surging all back at once. I believe that you're going to see it really in energy and in food. And that's why I think it's important to have an extra store of food. But bringing it back to real estate, this will lead to amazing opportunities, because as people are caring more about their energy bill and their food, they're not going to care about going and buying a bunch of homes. As a matter of fact, a lot of people that have Airbnbs, second homes, and rentals that are non-performing because people are straight up not paying them rent because they're getting laid off and having other inflation issues, they are going to look to secure things. And that's why I think it's super important that people get ready now and get ready for big opportunities. All right, guys, that being said, the Real Estate Ninja is out.